Hello, good evening and welcome. My name is Philip Duval. I'm the chair of Equality Northwest, a local group affiliated to the National Equality Trust, an organisation inspired by the book The Spirit of the Book. It's my pleasure to host tonight James Meadway, who is a senior economist at the New Economics Foundation. I saw James's excellent analysis of the state of the British economy at an event earlier this year in Manchester. And with all the hype about the recovery, I felt that I just had to bring him back to Manchester to introduce him and his particular analysis to a wider audience. So, with no further ado, James Meadway.
Thank you, and thank you for the invite to speak. I'm sorry about the delay in starting. It's sort of actually my fault for being too tied to a horrible corporate monster like Microsoft, who then force you to use their software all the time and not make do with nice fluffy open source equipment like Philip has. So I wanted to talk a bit about the recovery and start with that, and then talk about what's really going on, because there are two different things. I mean, you're probably aware of this. It depends on where you live, and it depends on who you talk to, it depends on what you do. But there's kind of a story, the official story about what's going on. If you live in London, I do live in London, you pick up, there's this free sheet, the Evening Standard, and it's basically sort of this continual kind of London boosterism. Everything is always better than everything else, and it's just awful, like pages and pages of these, fairly inane people and parties in glamorous dresses and house prices going up and everything's great. And then, of course, you visit anywhere else in the country and you get a rather different perspective on things. Certainly not one that the Evening Standard would talk up, and certainly not one I don't think that this government would particularly want to talk up. So I wanted to explore some of what the recovery means, what's going on, and where this gets us. Not that much about equality directly. There's a bit about inequality, and in particular sort of regional inequalities, which I think is dramatic, but we can talk about that in discussion afterwards. So this is kind of where we are and where we're going. Now, this is where they say, they being, them, the sort of the David Camerons, the George Osbornes, the much of the press, much of the kind of mainstream commentary says where we are, which is a recovery. Last 2 quarters, so about 6 months, reported positive GDP growth for the first time in ages. The threat of a triple dip, an unprecedented triple dip recession, dipping back into recession 3 times, apparently warded off. According to the Telegraph, the headline, the strongest growth in the developed world. It's growth that is reported to be occurring right away across different sectors, so not just services, which is what's been happening for the last few years. Service sector has been growing lots, manufacturing has been shrinking. So in other words, the balance of the economy was shifting more and more into services over the last 3-4 years, 5 years since the crash. That's now kind of balanced out a bit. George Osborne boasting about the creation of 1.4 million private sector jobs since 2010. The OECD, this is the rich economies club, there's about 32 countries in that now. They're forecasting 2.4% growth for the UK for 2014. They're always far too optimistic, just chronically over the last few years. But nonetheless, that's their forecast. It's somewhat above what everyone else is saying. And note this, of course, London house prices up by 10% in the last year. Mortgages nationally, the amount loaned in mortgages, up by 37%. It's an extraordinary increase over the last few months. The reality, of course, if you bother to sort of get away from the hype a bit, even on the headline figures, figures for GDP and the rest, doesn't look too good. UK GDP growth, the size of the economy, the rate at which the economy is expanding is no better than the Eurozone. It's basically comparable to the Eurozone. I've got a slide that shows you that. Next, growth here is better, you'll be pleased to hear, than Portugal or Greece, the people really in serious depression. It is worse than France or Germany over the last few years. It's benefited, this actually fairly weak growth, has benefited from a sharp fall in the value of the pound. The pound has dropped significantly, at least until the last month, in value. This should make exports from this country cheaper for the rest of the world. It should mean that you can sell more to the rest of the world. It should give you a bit of a lift on the other side, because you sell more things, it promotes growth. So it's benefited from that. There's been a huge amount of quantitative easing. This is the £370 billion of, to put it crudely, money that has been printed by the Bank of England and pumped into banks. Very, very low interest rates for years and years. And yet still you have a recovery that's no better than, crisis-ridden, as we keep getting told, crisis-ridden Europe. So UK GDP has gone up about 5% in the 5 years since the crash. US GDP has gone up 10% over the same period of time. China has gone up 60% in the last 5. So that's just to put that kind of recovery that we're now in perspective. This is a graph clipped from quite a good little blog run by Mike Burke, showing real GDP since the recession. So what you're looking at is the number of months down the bottom here. Months down the bottom here. Here's the recession. Here's the recovery that you see over the months since. For the United States in red, for the Eurozone, Euro area in grey here, and this is us. And you can see it's actually significantly weaker, a bigger drop than the Eurozone, a lower or even no recovery relative to the whole Eurozone, and then finally at the end just about catching up. So that's the kind of state that the economy is in relative to some obvious comparisons, relative to the US, relative to the Eurozone. This is index, so basically the bottom recession is 100, so as you grow up here, you go up ever so slightly against that index. So that's the kind of state of the economy comparatively. The experience that most of us has, because the graphs are one thing, and frankly what happens in France or Germany or America is one thing, but what it says for people here, I think, is something quite different. The striking one and the overriding thing that's happened during the last 5 years is the fall in real earnings. So the fall in the amount that people are earning after you take account of the increase in prices. So it's all very well saying your money, the amount your wage goes up and up. Inflation also happens. Prices go up and up. Prices have been rising faster than most people's wages have been rising. So in other words, the value of their earnings over time has fallen. And it's fallen by about nearly 9% since the crash. 5.5% of that since 2010. To put this in a historical perspective, this is the longest sustained decline in living standards for most people in this country, really since the 1870s. You have to go back to find Queen Victoria on the throne before there's any period of time where earnings of those in work has fallen consistently and continually like this. So you're going back over 100 years to find anything comparable. That's 2, 3, 4 generations by this point. Underemployment, which is the other interesting feature of this recession and very weird recovery that we're getting. Underemployment, the number of people who would say that they want to work more hours but can't find more hours to work, is at record levels. Absolutely astonishingly high. And it's a very unusual thing that's happened over the last few years. The government has boasted about it in a weird way, and I'll come back onto this, in that, when the crash happened, very, very sharp recession in 2008, the expectation was that unemployment would go through the roof. Previous recessions, when the economy starts to shrink, unemployment goes up. And it goes up quite some distance. You think back in the recession of the early 1990s, recession of the early 1980s, unemployment goes up really, really very high indeed. This time around, a crash happens, unemployment doesn't rise so much. It goes up, but nowhere near as much as people expected. What happens instead is that people keep their jobs but work less hours, and they get paid less whilst they're in work. So instead of everybody shifting into not having work, you have people in work, they're just getting paid less and they're working less whilst they still have a job. Except, of course, for under 25s, where unemployment is about 1 in 5. Under 25s are still out of work. So there's a big generational impact that's taking place here. Of those 1.4 million new jobs that Osborne says the coalition government has created over the last 3 and a bit years, 4 in 5 of those are in low-paid sectors, are in sectors of the economy that pay less than 60% of average earnings. So we don't know, we don't have the figures yet to be able to say they are definitely low-paid. It could be that everybody is getting jobs, for instance, in retail, and they're all becoming managing directors of Marks & Spencer. Right? That could be happening. It probably isn't. If you're seeing lots of jobs created in areas of the economy that are low-paid, they are probably going to be low-paid jobs. So 4 out of 5 new jobs created are in bits of the economy that don't pay very well. They're almost certainly low-paid. So if you're talking about a recovery, if you're talking about the private sector creating jobs, it's not creating very good jobs. It's creating low-paid, insecure jobs. And it's creating low-paid, insecure jobs, not particularly across much of the country. It's creating them in London. Now, this is since 2007. I'd like to get slightly more updated figures. But since 2007, 287,000 extra jobs have been created in London. But 276,000 have been lost in the rest of the country. So there's a shift in the pattern of employment that's taking place That's the net figure, of course. So lots of jobs lost, some new ones created. So if you're talking about a recovery, the recovery we've got, this recovery, is one in which most people are getting paid steadily less. The jobs that are being created are most likely low paid themselves and insecure. The people can't find enough work even though they're in work. And the work that's appearing is not evenly spread across the country. It's concentrated heavily in London. Not even the southeast, actually, just London. So the underlying problems. What are the underlying issues here? Because if you have a recovery like this is not really what's supposed to happen. What's supposed to happen is when GDP goes up, when the economy expands, we're all supposed to get paid more money, unemployment comes down, everything's great. That is what's meant to happen. If you've got a recovery like this, it points to much deeper problems. Problems became apparent really in the crash of 2008. Much deeper problems, things that start to get you into really kind of structural issues, very, very deep-rooted issues with the way the British economy functions. The one I wanted to pick out in particular, because I think it helps explain much of what else is happening, is this collapse in investment. That spending by businesses, investment by businesses in offices, in new machinery, in whatever they invest in, new equipment of various sorts, computers, whatever it is they're buying, that has collapsed, and collapsed very sharply in the recession over 2008 and onwards. That it was the biggest single pull, sucking money out of the economy. It was the biggest single pull making the recession happen. So it's fallen about 75 billion. Spending by firms has fallen by about 75 billion since 2008. It has not recovered since that point, and worse, investment spending is actually falling this year on the latest figures. So it's fallen during the crash, it recovered a little bit over the last few years, and it started to fall again this year. The key to this one is that without investment, without firms spending money on replacing worn-out equipment, opening new offices, whatever it is they're going to invest money in, it's unlikely that this very, very slack labour market, this fact that so many people are, all right, they're in work, but they're not getting enough work, they're not working enough hours, they're not being paid enough. It's unlikely that you're going to get this slack in the labour market removed. So, in other words, you're unlikely to see this pressure on real earnings for most people removed, unless investment starts to kick in. That's probably one of the things you'd want to happen if this recovery was going to turn into an increase in real earnings for most of us. That has to start to take place. The issue there is not that the firms don't have money. It is not the case, despite, in slightly different contexts, George Osborne saying the cupboard is bare. The recession happened, suddenly we've all run out of money. This is nonsense. It's embarrassing nonsense. What's actually happening is that large companies, particularly large companies, are sitting on cash. They are taking money in and they're sitting on it. So the amount of cash held in bank accounts by non-financial corporations, because that's everything that isn't a bank, broadly speaking, in December 2008, companies were sitting on £76 billion in their bank accounts. By July this year, they were sitting on £419 billion in their bank accounts. This is at the same time as investment is falling. So it's not the case that they're just not making the money. They're making the money and then sitting on it. They're not spending the money. And because they're not spending the money, the rest of the economy suddenly looks battered as a result. Incidentally, in the meantime, dividends, payments to shareholders have reached record levels, gone up by about 35 billion over the last 3 years or so. So they're sitting on most of their money, and then they're distributing some of the profits they make to shareholders. This is not turning into investment. This is not turning into things that produce jobs out the other end. As it says at the bottom, they could invest. There's a decision being made not to. And that's what's sustaining this kind of very, very weak, very peculiar sort of non-recovery at the moment. Now, there's an issue that you then get into here, which is sort of one about why. Why are they not spending? And a few people have floated this. People like Lawrence Summers, Paul Krugman, and other sort of big cheese economists have raised this issue of secular stagnation. Is it the case that economies, particularly developed economies like Britain, have just entered a point at which they're not really going to grow very much? They're just going to carry on kind of creeping along, that this pattern that we've got used to, really over a few generations, really since the Second World War, of having economies that grow at a fairly continual basis, 2%, let's say, every year, of a gradual expansion of activity that produces jobs, that produces investment, that gives us all the things we sort of expect to turn up, turns into rising living standards over a long period of time, unevenly distributed, but that happens for most people. Is it the case that you start to hit some barrier to this happening anymore? So they talk about secular stagnation. It's very old-fashioned. I mean, I always thought it was very old-fashioned. It's interesting to see it coming back in. Old-fashioned Keynesian concern. The earlier followers of John Maynard Keynes, the great liberal economist, particularly famous for his writings in the 1930s about how to get out of the Great Depression. They thought that secular stagnation would be what would happen after the Second World War. Alvin Hansen, an American economist, thought that you get secular stagnation, a long period of very, very low or no growth, or even a just sort of continual kind of decline occurring in the US after World War II, because he thought basically that as the economy grows, people get richer. Richer people spend proportionately less of their money. If people don't spend money, there's no demand in the economy. If there's no demand, the economy slows down. That's kind of the logic here. What actually happened was the biggest boom in human history. So it was kind of wrong at the time. But are there signs that something like this kind of slowdown is happening now? Well, this is, I hope, I'm going to sort of talk through what's happening with this. This is a graph showing what's happened for the G4 so-called countries. So that's the US, the Euro area, Japan and the UK. You kind of jam everybody together and you take their aggregates and you say what's happened since 2000. Now, the red line here shows their trend rate of growth. You ignore the sort of yearly fluctuations, and as you go from 2000, this is the trend rate of growth, extrapolated from the past, running into the future. So this bit here is a forecast. This is after 2012 into 2014, over here. The blue line is the actual kind of GDP it produced over time. It's indexed for 2008 to 100. That's the recession. That's the year of the recession here. So here's a blue line. This is actual GDP that's going on here. This is the amount that's actually learned. So this is the extrapolation. This is the kind of underlying trend rate of growth here. This is what's actually happened. Mostly you're quite close to the trend until you get to 2008. And then you break away from that trend, and then you kind of recover. Across the whole of the G4, recovery occurs. But here's the thing. Look at the gap between where we would have been without a recession, on the trend here, and where we actually are now. And that is the amount of kind of loss of potential that's occurred in that space of time. That's the evidence for secular stagnation. That it's not just that the recession produces a decline in output, which it does. Here's a decline in output. There you go. The economy's shrinking. It's just that when it recovers, it doesn't recover back onto the trend. It recovers just along here, and the forecast is running ahead here. So it recovers only along this far, rather than getting back onto trend. So in other words, there's this evidence that potentially, unless there's a sudden sort of sharp increase in growth, potentially there is this general slowdown of large developed economies, because they're not returning to their trend rate of growth over time. They're not getting back onto where they would have been without the recession. The recession, the crash of 2008, revealed something fundamental that's upset the whole economy. So what's driving this stagnation? Well, let's get back to the story. It's investment is the short version of it. The investment's completely essential to make growth happen. I'm leaving aside, by the way, the wider issue of whether you really want growth. That's a kind of tangled issue in itself. But let's stick to talking about growth, because it's the kind of thing that certainly David Cameron, certainly kind of conventional economists want to talk about as the most important thing. And the promise of growth previously was always that the economy gets bigger, you'll be better off. That's what's supposed to happen. What's happened over the last few years is apparently that has broken down. So let's talk about growth. Investment is essential for future growth. Machines, offices, ideas even kind of wear out. You have to replace things over time. Ideally, whilst you're replacing your machinery, you introduce newer, better technology, so you become more productive. You need that drive on productivity. You need to get people working more efficiently, because it says here, capitalism is a competitive system. It's a system in which every single unit within the system as a whole is competing with every other unit. They may incidentally collaborate. They may set up cartels. OPEC is a cartel to attempt to manage the price of oil. But broadly speaking, because capitalism is competitive, there's this compulsion on individual parts of capitalism, individual companies, eventually whole nation states, to compete and to drive productivity and to attempt to grow like this. That's the dynamic of the thing. So investment doesn't happen, you get no growth over the longer term. Growth slows down, but if growth slows down in a competitive system like capitalism, it's a serious problem. There may be reasons why you don't want growth. There may be good sort of social reasons why growth is not the only thing to go for. There's environmental impacts and all the rest of it. But if you're stuck in capitalism with no growth happening, that's a serious issue. That's a recession. That's widespread misery. This is not a good place to get into. If you're looking at a future in which growth is slowing down over a long period of time, the future can start to look really quite bleak over a long period of time. Now, UK investment in general is weak. This is investment by British businesses as a share of GDP, as a share of the whole economy from 1948. And you can see it kind of peaks in the 60s and 70s, a period of very fast growth for the British economy, and then declines sharply into the 70s, through the 80s, through the 90s, weird dip in 2000, which I think is just a blip in the figures rather than anything more substantial. Something of an increase up until 2008, and then a crash back down here. Some slight recovery since, but then a decline at the end. The important thing to note is, look, here is where we are now, here is where we were in the 60s. Now, if investment is what is driving growth, your prospects for future growth being anything like what was happening in the 50s and 60s are very, very low indeed. Also bear in mind that every other major developed country invests far more as a share of GDP than Britain does. There's a kind of long-term historic problem there. The particular instances where this gets us into a story about the regions, and inequality and finance, which are the three things I want to cover here, is related to manufacturing and related to the manufacturing sector. And the story really looks like this. And you'll go this way round. Firstly, Britain has maintained a current account deficit since 1983. So for the last 30 years, this country has consistently imported more than it has exported. It consistently, every single year, buys more from the rest of the world than it sells to the rest of the world. This is largely the result, if you wanted a sort of condensed version of the story, it is largely the result of deindustrialisation, of the loss of manufacturing jobs. So you lose manufacturing jobs on a huge scale, 1979 to 2008, about 4 million go. You shrink manufacturing as a share of the whole economy, and you shift into producing services. The difficulty, and the relationship back again, is that services are not sold abroad. You can sell cars anywhere in the world. It's very hard to sell haircuts anywhere in the world. Like, you can't, short of persuading people to fly in, or you fly out to them, which I'm sure if you're incredibly wealthy you can do, but mostly this doesn't happen. Services aren't traded. So if your balance of your economy shifts away from producing stuff that can be sold abroad into stuff that really can't, in the main, you're going to end up not selling much to the rest of the world. You're going to end up with this current account deficit. So the shift out of manufacturing means you're selling less abroad, means you run a current account deficit. The reason that matters is you can't just buy more from the rest of the world than you're selling to them forever. You know, there's a gap. You have to finance the gap one way or the other. You have to, by some means, come up with a way to close that gap in order that you can maintain this situation. Particularly if you're doing it for 30 years. You can do it for a couple of years maybe, but for 3 decades now. It's a difficulty. So you have to plug the gap. You want to buy more from abroad. You can't sell much to abroad. You have to plug the gap. The gap is filled fundamentally by finance, in particular by a very, very large financial system, very large, very internationalised financial system that we have in the UK that could mobilise funding from abroad to cover the gap. So the short version of this is we don't sell enough to the rest of the world, so we borrow from the rest of the world so we can carry on buying their stuff. That's the kind of shorter version of what's taken place for the last 30 years. What it means is that you have a dependency on being able to mobilise borrowing from the rest of the world. Because of this current account deficit, because you're not selling enough to the rest of the world, you have a dependency on being able to borrow from the rest of the world. So you're dependent on having a very large, internationally focused financial system that can mobilise the borrowing. So you can keep this basically unbalanced system ticking over. colours I hope would come out all right here. It's an attempt to show roughly what's happened since 1987. The red line is just the trade in goods and services. So it's not all of the current account, it's just services and goods. Net, bought and sold from the rest of the world. So when it drops down here, that's a deficit. It goes negative, that's a deficit. That's when you're buying more from the rest of the world than you're selling to the rest of the world. When it goes up here, it's in surplus, which happens very briefly over this period of time. The reason it's not in deficit the whole time is that stripped out payments, basically payments to the EU. Once you stick those in, everything shifts down. So, net financial flows is your borrowing from or investing in the rest of the world. If it's negative, you are lending to the rest of the world. If it's positive, you're borrowing from the rest of the world. So you can see the relationship. You go into a very big deficit here, you have to borrow lots and lots over there. You go into deficit on your current account, you borrow lots and lots to cover up for it. The two work in parallel over time. What are the results of dependency? Well, the obvious part of this, it means that debts explode. It means that over time you develop an awful lot of debt in this country. To the point of being just about, the UK just about now, is the most heavily indebted developed country anywhere in the world, as a share of GDP. Vying with Japan. I mean, Japan is maybe slightly ahead, maybe slightly not. The total size of UK debts is about 502% of GDP. The important thing to note here, in complete distinction to the government story, is that this is not government debt at all. This is debt of the private sector. Government debt is a tiny, tiny fraction of the total amount of debt that this country holds. So the kind of nonsense you've got from Osborne, Cameron, Clegg, the rest of it, actually it's been not just last 3 years, it's been 5 years. You know, Osborne's nothing if not consistent about this. The nonsense you've got that the public sector debt is the most important thing to worry about, it just doesn't stand up. The most important chunk of the total amount of debt owing this country is in the private sector. There's another graph that attempts to show how that debt is broken up. The purple bit here is a share of GDP from 1987. The purple chunk is government debt over here. Now you can see in 2008 it does expand, right? This is the crash, this is the bailout, that's what's happening there. But really, it's not very much relative to all of this. Taken together is private sector debt, which by 2011 at least is about 420% GDP. That private sector debt is then divided into household debt in green, quite a big chunk, non-financial corporations in red, so that's companies that actually make stuff, and this whacking great expansion of debt, which is the debt of the financial system, the debt of financial institutions, banks, major insurance companies, all that sort of thing. So the biggest single chunk of this private sector debt over time is the debt that the financial system is generating itself. That this is a kind of game of pass the parcel amongst banks. You can generate a bit of debt, loan it to another bank, they can pass it off somewhere else, or they can sell it back to you, or you can do any number of clever things with it. Whatever else happens, you expand the liabilities of the banking system hugely over this period of time. And that's basically the kind of bubble that you see emerging all the way up to 2008. And then, of course, interestingly, if you can just about see there, since 2008, debt of the financial system relative to GDP has not declined at all. It's not like banks are getting rid of their debt. They've not actually learnt very much from what happened in the crash and the rest of it, despite, again, some rhetoric around that. So what does that mean for sort of more practical terms? You can talk about debt in the aggregate and finance in the aggregate. I think the most striking part of the story of this kind of financialised, heavily financially dependent economy, heavily biased towards the service sector, is it has very specific regional impacts. The regional differences between different parts of the country in Britain have always been large. You know, problem with depressed areas in the 20s and 30s, decline of traditional industries after 1914. What happens is that this kind of new finance-led economy we get appearing, particularly after the 1970s, exaggerates those existing differences. You get this strange combination of, as it says there, a sort of economic backwardness, that regional differences have been there actually probably since the 1870s, really, is where it starts to become pronounced. This problem of areas of the country not getting investment, not creating jobs, not producing growth, not producing output. on one side, and then you get this very, very advanced version of capitalism, this very financialized version of capitalism. You get the big banks, you get the huge amounts of investment going in there. On the other side, and put together, it exaggerates the regional differences quite starkly. This was tucked away, this graph was tucked away at the back end of a report by ONS, by National Statistics, without any fanfare at all, which I kind of stumbled across. And just to talk you through the thing, what it shows you is the distribution of output for every EU member. Belgium at the top, Greece, Spain, that sort of thing. The distribution of output for each of those EU members spread between the richest areas over here down to the poorest areas over there. So it shows a regional spread of output for every single EU member. The black blob is their capital city, usually the richest part of the country. Germany, very obviously not. It's a clear exception. But usually the richest part of the country is the black blob, is the capital city. The blue lines are kind of average for the whole country. So most places have a bit of inequality. Right, there's Belgium, it's got quite a spread. Germany, quite a spread. Estonia, really not that much. Spain, a bit more. Most places have a bit of a spread of inequality. There are rich places, there are poor places. You can go all the way down the list, and here's the United Kingdom. Right? So this is London, or rather City of London, central London, is the richest single place in the whole of the EU, just here. All these are shown relative to the EU average, by the way, so they're comparable. Richest single place in the EU, and then all the way down the bottom is West Wales, which is the poorest place in the country, and at the same time, if you look, comparable to recent accession countries like Bulgaria or Romania. And this is within a single member state. There's extraordinary spread of regional differences. And that's what I mean about this financialisation, this drive to use and this dependency on the City of London and the financial sector producing a regional outcomes. Because this is worsening over time. It's worsening quite markedly at the minute. It's always been quite spread. It's just getting worse and worse and worse. There's a very particular impact that appears as a result of the kind of economy that we live in. So the regional consequences of financialisation. Earnings finance grew largely to the southeast. 45% of gross value added, amount of value added, so-called, produced by financial services appears in London. Earnings are themselves extremely unevenly distributed within financial services, and this is a well-known fact by this point. This is what the bonus payments mean. You know, the bonus payments are now so big they have to present two sets of figures for earnings growth. One with bonuses in, and one with the bankers' bonuses taken out, that they're so large and so concentrated on so few people. That notably, finance does not create jobs. This is one of the things it does not do. It does not itself create jobs. Employment in finance in 1992 is 1 million. Employment in finance just before the crash in 2007 is 1 million. It has enormous growth over that time. It doesn't create jobs. What happens is a few people get very, very wealthy indeed. And the result is basically damaging to the economy outside of London and the southeast, especially during the crash, as a result of the crash of 2008. This was Carol Williams from the University of Manchester's quip that profits are metropolitan. Profits are all made in the city of London. But losses arrive nationally. That you make all your profit here, and there's a specific regional impact that occurs because you make your profit in a particular part of the country. But then when everything goes pear-shaped, everybody has to carry the can for it. So you win on the upside, and then you don't really lose on the downside, is the kind of deal that you end up with here. So it's damaging to the rest of the country. So that particular argument about how everywhere else outside of London should be grateful for London for earning so much money just doesn't stand up. You know, what's the guy who used to edit the song? Kelvin Mackenzie. You know, he's been quite obnoxious about it. Boris Johnson, less obnoxious. This idea that what's good for London is good for everywhere else doesn't really apply, doesn't work in practice. Just a sort of slight nod in the direction of theory here, I suppose. That what you can talk about, perhaps, I say nod in the direction of theory, it's also a bit speculative, but let's go with it. The core and periphery, this idea of a core economy and a peripheral economy, is an idea from development economics. It's meant to describe particularly relationship between developed countries and undeveloped countries, or regions within countries in the developing world. The key part of it is it's a hierarchical relationship. It's a relationship of a power imbalance. that the core is the powerful bit and it exploits the periphery. The periphery loses out from this relationship. The core does well. It exploits the kind of power relationship here. Now, I think you're starting to see elements of this appearing inside the UK. That London, and to a lesser extent the rest of the South East, earns from finance. The rest of the country, because of a power imbalance, has to pay for the consequences of them earning from finance. And just to be very clear about this, when I say London, I don't mean everybody in London. London is now the most unequal city in the OECD. Some of the very poorest parts of the whole country are within literally walking distance of some of the very richest. That if you go from Canary Wharf, you can walk half a mile down the road into the rest of Tower Hamlets and see really desperate poverty. So it's not evenly distributed within London. The streets really aren't paved with gold unless you're in Kensington. So the rest of the country pays for the consequences. To put it another way, total taxes from finance, income taxes, corporation taxes, capital gains taxes, just everything added up, 2002 to 2008, £193 billion. The total cost of the bailout, indirect and direct cost of them bailing out the financial system over 2008 to 9, this is the IMF, the International Monetary Fund estimate, is £1.3 trillion. So you get a bit in taxes during the boom, you pay an absolute fortune when the crash occurs. This is clearly not a good relationship. This is clearly not one that benefits everybody to have this kind of imbalance established there. So that's the kind of core and periphery relationship. What you see essentially is kind of London-centred growth. There's a UK-wide imbalances drive a dependency on this London-centred financial system. The imbalances being particularly the current account imbalance. You import more than you export. There's an argument, as I said, that London and South East funds the rest of the UK, but in fact the crash of 2008 develops in London, but then the whole country pays for it. So it's an unequal relationship. I clipped this. Actually, no, I mean, the point stands anyway. Scotland somewhat escapes, I think, from this kind of general pattern because it has had a devolved government over the last, however long, 1999, 14 years or so. And it escapes somewhat from that general pattern. It functions as something of a different economy to the rest of the country by this point. But broadly speaking, for England and Wales, this is certainly the pattern of development over the last few years.